Right now, the biggest companies on Earth are passing hundreds of billions of dollars around in a circle and calling it growth. Chipmakers invest in AI labs. The labs spend it back on chips. Clouds fund the labs that rent their servers. In the next 9 minutes, how big this bet really is, why it echoes 1999, and what happens if the music stops. Start with the scale. Total spending on artificial intelligence is expected to blow past $1.6 trillion. America's tech giants are pouring roughly $750 billion into the build-out this year alone, praised by officials as a golden age. And unlike most manias, this one isn't hiding. Everyone can see the circle. Almost nobody agrees on what it means. Meet the flagship bet. One leading AI lab has committed to spending $1.4 trillion on computing over 8 years. Its yearly revenue, when it made those promises? Around $13 billion. That's committing to spend roughly 100 times what you earn. Where does the money come from? Increasingly, debt. Analysts expect $3 trillion in data centers by 2028, half funded by private credit. Private credit means loans from funds, not banks. Faster, looser, and much harder for regulators to see inside. The build-out is physical too. Chip plants, power deals, whole campuses. Headline partnerships promise 10 gigawatts of computing at a time. 10 gigawatts is roughly 10 large nuclear reactors worth of power for training AI models. And more deals land every month. Stock markets have noticed. A handful of AI names now carry a huge share of the entire market's value and its optimism. If this feels familiar, it should. We've run this exact experiment before, 25 years ago, with the Internet. The late 1990s. The Internet is obviously the future, and that's the trap. Being right about technology says nothing about prices. Money flooded anything with .com in the name. No profits, sometimes no product. Worth billions overnight. Telecoms buried millions of miles of fiber for traffic that wouldn't arrive for a decade. Sound familiar? The crash came anyway. The Nasdaq lost almost 80% of its value and needed 15 years to see its old peak again. Here's the twist people forget. The internet optimists were right. Online shopping, video, everything they promised, it all happened. The bubble was never about whether the technology was real. It was about how fast the money assumed it would pay off. And the fiber they overbuilt? It later powered streaming for the whole world after the original investors had been wiped out. So the question for AI isn't, is it real? It's who survives the gap between the promise and the paycheck. Now the circle itself. Watch the money move. A chip maker invests billions into an AI lab. The lab turns around and commits those billions to buying that same chip maker's chips. Revenue for the chip maker, its stock rises. The lab also signs giant deals with cloud providers. Clouds buy more chips to serve them. The same dollars keep resurfacing as everyone's growth. Critics call it circular financing, an industry partly paying itself and booking the loop as demand. Supporters call it building the railroads. The danger isn't that circles are illegal. It's that they make demand look bigger than the world outside the circle. Because eventually, someone outside must pay. Businesses and consumers buying AI products at a profit. That's the whole game. To be fair, this is not 1999 on repeat. Let's steelman the optimists, because their case is serious. First, unlike the dot-coms, today's giants are wildly profitable. The spending comes largely from real cash flows, not fantasy valuations. Second, the head of the Federal Reserve himself argued AI companies generate real revenue, and their spending genuinely drives economic growth. He has a point. AI investment has been carrying a visible slice of America's entire economic growth lately. Third, adoption could still explode. If AI really automates big chunks of work, today's spending will look cheap in hindsight. That's the bull case in one line. The railroads were worth building, even if some builders went bankrupt, laying the track. So who's right? Time for the uncomfortable data. The numbers that keep even the optimists up at night. Number 1, usage. In early 2026, researchers surveyed thousands of firms about AI at work. 90% reported no productivity impact. Number 2, the gap. The industry pours roughly $400 billion a year into infrastructure, while enterprise AI revenue sits near $100 billion. Number 3, concentration. The 10 biggest stocks now make up about 35% of America's main index. At the dot-com peak, 25. Number 4, fragility. In early 2025, one cheap Chinese model appeared and the top chipmaker lost $600 billion in a day. And now the referees are worried. The central bank of central banks warned this bubble could pop and drag the world economy down with it. Even inside the US Treasury, a draft report compared today's AI market to the dot-com bubble, with far deeper roots in the economy. And when one mega deal merely stalled, panic hit 3 giants at once. One cloud builder's shares fell 40% in a month. Real technology, real revenue, real debt, real warnings. History says this mix resolves one of 2 ways, and both start the same. The fear. Way 1. Adoption catches up, profits arrive. Way 2, the repricing. Markets stop believing the timeline. Valuations fall, credit tightens, and the weakest borrowers in the circle go first. A crash wouldn't stay in tech. Rising stocks currently add real spending power to the economy. A correction pulls that straight out of growth. The dot-com pattern would rhyme. The technology survives, the infrastructure gets reused, but a generation of investors pays the tuition. And history's biggest bubbles, Japan in the 80s, housing in 2008, took economies down for years, not quarters. Nobody rings a bell at the top, but everyone can watch the same 3 dials: adoption, debt, and demand from outside the circle. Our honest verdict: this is a real technology wrapped in an unproven business model, financed at a scale with no precedent. Bubble or breakthrough? Probably both, in sequence. The technology tends to win eventually. The early money, quite often, does not. Whatever happens, you now see what most headlines miss: the circle. Follow the money, and always ask who's outside it paying. Next episode, something completely different: the $1.50 hot dog that a retail giant refuses to reprice, and why it prints billions. Subscribe for more. Money makes the world go round. We show you who spins it.